Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Zinati Guma, and joining me to unpack your stock-related questions today are Mutooni from Sanlam Investments and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. I remember, I think I was 6 months into my journey as a business news anchor, and I thought we're having the same conversations, not necessarily the same conversations, but it's the same topics that keep coming up all over again. I mean, I've gotten used to it because obviously there are different dynamics in which to approach the different topics. But with gold, we sound like a broken record, another record high every day. Ricus, I want to start off with you because we're seeing such strong gains. Goldfields up 8%, Sibanye also over 8%, Harmony over 6%. Is it not surprising anymore at this point, the gains that we're seeing on gold?
It's extraordinary, but not surprising in the context of geopolitical uncertainty and dollar weakness, frankly. As to how much further this can go, who knows? We've had 4 bull runs in gold since the 1970s, when when the gold price started floating, and the average gain for gold on those 4 occasions was about 250%. We're sitting with 150%. It's 4 data points. I wouldn't even glance at it as any kind of statistical probability. But I think what it says is that when gold fever takes hold, it can go much higher than you expect.
All right. And of course, we're not complaining as much as it is the same thing every day, but we're not complaining because the Rand is doing very, very well. Just on that, as we're talking about gold, I want to go into Pan-African Resources. I don't know if I've lost. No, I have not lost that question. What will the impact be on Pan-African Resources share price with the listing on the main board of the London Stock Exchange early next year? Surely this will impact the JSE share price positively. I think I actually remember on the day that we did see some movement on the actual JSE share price. Roy, your thoughts there?
It's positive. See, what happens is when you go onto the main board, your profile and visibility increases, which also means that passive buyers must buy you because it will be part of the all share or the gold mining group of shares on that main board where there's greater liquidity and greater interest. And when passives buy, then more money comes through, they need to invest, your liquidity goes up, your profile goes up, your share price does go up relative to your peers that are also listed on that main board. Clearly, the share price reflects the same underlying asset. So that would be reflected in Joburg as well. I think the important thing here is to understand where the price is being set. The good thing about this is it's being set on the basis of the gold price and amount of gold produced. And then now you've got one other place where you've got a preponderance of big, deep-pocketed investors who can tolerate higher ratings and higher valuations. So in all likelihood, that translates into a higher share price, both in sterling and in rand. So I think the operative thing here is it's the same underlying asset. You're just exposed to a deeper pool of capital, a deeper, more visible pool of capital.
All right. Well, there are quite a lot of questions on Afrimat, just Afrimat on its own, but also comparing it with other counters like Sasol and Aspen. Let's start off with Afrimat itself. Is it a good buy now? I know that Ricus, Afrimat had been under pressure for a long time, of course, because of the commodity down cycle, but is it looking like a good time as it's turning the tide?
Yeah, to sort of look at a monthly chart, and on that basis, it's getting there, but it's not there yet. So we've had a rebound over the past few weeks from some kind of bottom, whether it is the bottom, I don't know.
Okay.
But they still need operationally things to get better. The cement side of business needs to turn around. Their coal is a problem. Iron, as we know, is not, or iron ore at least, is not the commodity to be in at the moment if you compare it with something like copper or aluminium, for example. So their results or their trading update, obviously a heck of a lot better than the previous period, but from a very low base. But I don't think there's any rush to go and buy it at the moment.
It's actually quite interesting because we've seen all these companies in the resource complex, or that are companies that are that have exposure to resources actually making significant gains. And I'm actually looking at that 1 year chart for Afrimat, and it's nowhere near where it was a year ago. And I'm just trying to think, compared to what everything else that we're seeing that's exposed to resources, I don't know, does it look like Afrimat is behind here, Roy?
I think you have to separate precious metals, gold and flats.
Yeah.
And the diversifieds that are going through M&A. So that's Anglo from this whole mix. If you look outside of that, pretty much nothing else has happened.
Okay.
I mean, Exaro had a little bit of a trot, but nothing else. Afrimat is caught in two different cycles. There's one, which is this commodity cycle that we're speaking about, whether it's with regards to ferrochrome and all of that. And secondly, its own operational issues that it needs to deal with because of the acquisitions that it has made. So management, like I've always said, solid, strong reputation as turnaround specialists. But they've got many things they need to watch now. They need to watch the steel cycle, they need to watch the cement cycle, they need to know about construction materials like they did before. There's a whole lot of other things they need to do that they didn't have to do before. And I think it's the combination of all of those things and the point in the cycle that has probably compressed the share price. Now, for the share price to recover, you probably need to see volume growth, better execution, and the commodity cycle itself to turn in aggregate for them to move. So like Ricus says, it's probably early in the cycle. It has sold off considerably and for a long period of time, but people must understand it is a far more complex business than it used to be, and the cycle has not been in its favor. And as well, some of the challenges that they've taken on have been significant, and it's required a lot of management attention to turn around, particularly that old Lafarge business that they bought. So I think it's a slow grind. It's one to keep watching. I would still back management, but it's going to take time for this to go back to the highs that it had previously.
Okay, so we have Afrimat, some operational issues, slow grind, and the pricing cycle in terms of what they're exposed to not really having a huge upward momentum. Now, let's take a look at Sasol, because there's a viewer who's trying to compare Afrimat to Sasol, looking at, asking which one will bear more fruit. We also know Sasol also has operational challenges, and they also rely on pricing in what they are exposed to. So which investment bears more fruit? Afrimat is looking juicy at 42 Rand, but then again, Sasol was looking juicy at 120. Yikes. Ricus.
Well, I'm waiting for the operational update, which is due in October, to see whether the optimism that surrounded the last quarterly update is maintained. At the moment, the oil price is not helping them. I mean, oil is, or Brent is at about $60 a barrel at the moment, and that's well down from 70. You know, I think around about 70, 75 where it was 3 months ago. So they're not getting any help from that. But the um, the action in Sasol will not necessarily be in the product they sell, but in the way that they are reshaping their operational efficiency. So I'm cautiously optimistic, but I think a lot's going to depend on what happens in the next 2 weeks when they update the market.
Well, I mean, it's been a while. Even cautiously optimistic for me sounds good because it's been a while since we've had optimistic attached to Sasol. Roy, on your side, I mean, just comparing the two, because I'm thinking that the viewer wants to know where to place his money. Would you be going for any of those at this point, seeming that they are both a slow grind?
So Sasol, again, very similar to Afrimat, there's probably three buckets that you need to keep your eye on. The first is the oil price, like Ricus said. For sure, that's going in the wrong direction. And the rand oil price, remember, is what matters. And the rand is stronger, and the oil price and the dollar oil price is weaker. That's one. Then there's the chemical dynamic, where globally you have an excess of chemical manufacturing capacity that competes with them, so prices are subdued and volumes are not growing. And then there's a self-help component, which is the internal focus, the paying down of dollar debt, improving of margins from efficiency, the battle around ESG and what to do with Secunda and all of that. So there's those three pots. Now, which ones of those can management control? Because that's what your investor is effectively asking. Look, they can do a lot around paying down the debt, and speaking to them, they're very focused on how they'll transform that into rand debt and move it around and everything. But the other two, they have no control over. So your guess is as good as mine for what happens. And my gut feel is the oil price doesn't recover, the rand remains relatively strong, and the excess capacity in the chemicals market remains. They can go a long way by fixing the operations. That's for sure. And that's where I think a lot of the optimism came from. But does that allow them to re-rate to a 10, 12 multiple or grow earnings dramatically? I mean, we have to wait and see. That's the thing. I think when the investor is comparing these two, these are commodity-based things. There's very little management can do for the overall investment thesis. They can fix up the operations, but they are far bigger commodity drivers than these guys can handle on their own. Trust the management teams, yes, but a big swing either which way will determine what happens to earnings in both these companies.
Okay, yeah, so it will also depend on your own analysis of the macroeconomic dynamics. The next viewer says, we have these three big companies on the JSE, all trading below 52-week lows. I have 3 million rand in cash and thinking of investing 1 million rand per stock and ride it out for 3 years. And this is Aspen versus Afrimat versus Sasol. So the viewers basically think of putting 1 million in each for 3 years. And the viewer asks, is this a clever decision or will I be crying in 2028? Roy, you've said we have to wait and see. Both Sasol and Afrimat. When I add in Aspen to the mix, because we know that they've had their own problems, how would you be approaching the viewer's question?
It's an interesting perspective. Like I said, the issue with the first two is if you can call the commodity cycle right, then I'll be with you. Then we know where we're going. Tell me where the rand will be. Tell me where those commodities will be. And then it almost doesn't matter what management does. So long as they don't completely mess it up, it will go with that flow. With Afrimat, we like management. We think over time it will work out, and you combine them and a moderately improving commodity cycle and some things to happen positively in SA, it probably is a reasonable investment to have over that period of time. Sasol, tell me what's going to happen with carbon tax. Tell me whether they're going to get a fresh source of Is it gas or the secunda coal? Where's that? What's going to happen? And then how are we going to resolve the global glut in chemical prices? Give me that answer, and I'll say the way I've seen management, I think they'll solve the dollar debt situation, and it probably works out. And maybe it re-rates a little bit, and they pay a big dividend, and it's worth 150, give or take, or even more.
Okay.
Then Aspen. So Aspen is the one that is up and down. But they've recently managed to get this thing for the GLP-1, the Mounjaro contract, which could be really positive for them. But they're also in the situation where they're high in debt. They are cash generative, but they have to manage that debt, and they have to decide whether they are this generics producer, whether they're this manufacturer, and whether the old business model fits into what they're trying to do right now. Stephen Saad, very astute businessman. He's made the right decisions many times before, but now this is a bet on whether all of that comes together and whether this Mounjaro actually catches traction here in South Africa. Again, big questions. A lot of them not under management's control, so you don't actually have a big franchise here that management can drive. So very cheap shares. In all likelihood, you don't have much downside, but I always get afraid of cheap shares with high debt and difficult operating conditions. Always be concerned, particularly when you have operational leverage as well, which is what Aspen gives you. High operational leverage and large amounts of debt. It works out, you do well, really. You do incredibly well. If it doesn't work out, it's curtains for you.
Yeah. It's quite interesting also what you say about Aspen, about it being up and down, because it's not the first time that they're dealing with debt, and, they did solve it at some point, but now seeming that there are concerns about debt again. And I guess it's model in general. Ricus, how would you be approaching Aspen on its own, but also relative to these two counters that we've spoken about?
Yeah, it's a brave decision if you take that kind of 3 stocks for 3 years. That's not the way I manage stuff. I don't like losing money. So let's say one works out spectacularly. It might make up for the 2 that don't work out, and possibly one that really disappoints. You're all over the place. So it's not the kind of decision I would make.
Yeah, okay.
But as I said, maybe one works out spectacularly for all the various reasons that Roy just mentioned. But why do that? I mean, if you want to make a lot of money, yes, have a concentrated portfolio, or as I said before the show, put your eggs in one basket and watch the basket very carefully. So don't go and buy it and wait 3 years and then sort of open up your box and say, okay, what worked and what didn't work. Manage the stuff. If you really think all 3 has potential, by all means invest in it, but make sure that you don't lose money. And if one of them works out, ride that wave. That's the way to do it, rather than just buy right now and hope for the best over 3 years that one or all 3 of them might recover.
Okay. Well, I did say that there are lots of questions on the commodity counters. We have one on coal, Thungela. Is it time to buy Thungela? Also, another counter that does depend on pricing for coal. But Thungela, I don't know, it seems to be doing quite a decent job. Roy, would you be in agreement or not?
So on the one hand, you'd think that global demand for energy should be growing because of AI and all of that. But on the other, the coal price just is not recovering.
Yeah.
That's one thing. Thungela mines here, and they're limited by what Transnet is able to give them in terms of capacity to export. So they've done a couple of diversifying acquisitions, but it is just a commodity company. Again, I go back to, are you confident in the ability are you confident that the coal price will recover? 1. 2, are you confident that they're able to get the volumes that they want to port and out into the markets? Okay, so those are the difficulties with these industrial commodity businesses. Just remember, we're in a world where most developed markets' growth rates are being downgraded. So in the aggregate, global growth is being downgraded, not being upgraded. If it's being upgraded, then there's lots of demand for energy, lots of demand for capex, and all of these commodity companies should do well. Just make a note that right now what's running is precious metals, which tend to run at a time of worry and concern and inflation. So there's a big difference between industrial metals and precious metals. And I think the industrial metals are a reflection of growth, precious metals are a reflection of uncertainty and concern. That's the game that we're playing right now. So I would avoid all of these. I don't think Thungela will have as big a dividend as it had historically. And again, I go back to the commodity argument.
Your take on Thungela, and if you would be taking a chance on it, Ricus.
Yeah, I think Roy had an important point there. Thungela will depend on energy demand derived from coal. If a developed market is not growing, as the IMF just warned, you will probably not take offtake from there, which then leaves you with China. And let's face it, China is not growing. And then you can dig in deeper and you say, okay, but let's say there is energy demand because of AI and the investment in plant and the energy associated with that. If I take a look at the headlines, nobody's building coal mines to drive these AI centers. They're all looking at nuclear. They're all looking at other sources. I think it's is it Google that's doing hydrogen at the moment. So that's not where or the energy demand for the AI revolution is not tied into coal as far as I can see.
Okay.
So why be in coal?
Okay, very, very interesting points that you gents make there. Well, let's get on to your very interesting stock picks for today, because you're both going into the food producers. We do have a question on AVI, but that is Ricus' stock pick. But Roy, you are going for Premier, which was quite interesting because we did see it surging earlier on in the day, but it actually ended off in the red. And I don't know if that's a function of it being the acquirer. So why are you choosing Premier today?
So again, just going through the profile of your investor who said in 3 years' time. So Premier, since listing, has delivered pretty much on everything they've said. They've got this huge bakery that's coming through, low cost, reasonable margins. Wherever they are now number one, and they're entering into the biggest market in the country. They're going to take on Tigers, and it's going to be an epic battle, but they seem to be doing well. They've been growing earnings 20% each year by reducing their costs, reducing their debts, and just basically running a very tight ship. Now, when you look at that profile and when you speak to them, it was clear that could continue for another 2 or 3 years. But now if you add Rhodes in, Rhodes has a fantastic prepared meals business that's quite significant in Woolworths' life. And all those meals that you see in Woolworths come from Rhodes. So that's a business that's cleaned out its debt. Its margins are at 10%. The management has kept a very tight ship there and grown really well. So that is what Premier would have wanted to do in 2 or 3 years' time when the bread growth had probably gone away. They're bringing it in now. Okay. There's synergies, there's costs that you can cut, there's head office that can go away. So you've got a compounding effect on that 20% earnings growth. So to me, it's not overly expensive. This is a synergistic acquisition that will come through. They're using shares, it's earnings enhancing. I see absolutely nothing wrong with it, and I'm more than willing to back management for the next 3 years. I'll basically get this one, put it in the bottom drawer, sleep. In 3 years' time, we'll see earnings at a completely different level and a whole new diversified food business.
Well, another business in that food production sector is AVI, that one has long been on the radar of investors in terms of being a takeover target, and that is AVI. The viewer says it is currently cheap considering the potentially high dividend yield, and of course I'm sure you think so as well, Ricus, as it is your stock pick.
That's part of it. They're also ex-dividends, so the share price has given that back. So I think it's at buyable levels, and it's, with a very decent dividend yield, considering the consistency of their earnings. I'm looking at a price target, but both on a technical basis and fundamentally, of around about 115 rand. So that's 15-18% potential gain. But more than that, the Premier Food announcement today, they won't be buying Rhodes Food Group if they don't think that sector in itself is providing value at current prices. So it's not merely an AVI story. I think it's a sector story as well. Food producers are cheap. It looks as if rains are going to be in our favor. So your input costs is not going to be affected by a sudden drought by the looks of things. The sector itself, and I think AVI specifically, and I agree with Roy, Premier Foods, probably at buyable levels.
All right. Well, thank you so much for your time. A very interesting episode today, gents. Really appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Mutooni from Sanlam Investments and Ricus Reeders from PSG Hole in Ruimsig. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.